So welcome everybody. As you're joining in, if you could just drop in the chat where you're joining us from. Today's session is going to be very, very interactive. This is like really for you to gain as much value as you can from this. This is your session. This is like you getting like a free tax advisory session from a very, very renowned accountant. So this is your session. All the questions you have about taxes, whether it's your personal taxes or business taxes, Mr. Elvis is here. So again, please don't be shy. Once we get started, this is your presentation. So we typically give it till about maybe 7:03, 7:04, then we get started. So welcome everybody, and thank you for joining us this evening. And you're gonna get a ton of value from this, a lot of value, So and the goal is that when you leave here tonight, you're gonna learn something that will help you save at least $1,000 in taxes. And so just drop in the chat. If by the end of the night, you've learned something that will help you save an extra $1,000, would you say the time tonight has been worth it?
Yeah. And maybe you can send me $200 for saving you $1,000. How about that? Does that sound good?
I'm sure. I'm sure they won't mind doing that. So welcome everybody. Thanks for joining us. Yep. Tenny said absolutely. So we'll give it a minute, then we'll get started so we're respectful of everybody's time. All right, again, welcome to this tax presentation. Taxes is not a topic that I really enjoy, but when I got into as a professional and started making certain income, I realized, oh my God, this is something that I got to pay attention to, because if you don't, Uncle Sam takes most of your money. So,
but we know there's two things that are absolute, right?
What is it? Death and taxes.
Right. Those are the two absolute things.
Yeah, no, that's correct.
Yeah.
All right. So it's 7:03. I'm going to go ahead and get started. We have people trickling in. Welcome everybody. Welcome to this presentation brought to you by the Beyond 9 to 5 Club. The Beyond 9 to 5 Club is a community founded by the founders of Excite Capital to provide value to other 9 to 5 professionals so that we can all learn and continue to share knowledge on how we could grow wealth and build financial freedom outside of our 9 to 5. So today we have a very special guest. It took me a very long period of time to get Mr. Elvis on this platform. I've been talking to Mr. Elvis since October of last year, but he was very busy. He's a very busy man, very sought after CPA in the area. He was very busy, and he just had a kid too towards the end of the year, so could not join us on any presentation. So, but I was able to get him to come today to come talk to us about taxes, share with us some of the useful techniques or some of the useful tips that we could leverage with all the changes that is happening in government right now to capitalize so we save most of the money that we make. So without any further ado, I'm going to do a brief bio introduction of Mr. Elvis, then I'm going to pass it over to him. So Mr. Elvis Langha is the founder and principal of LGE Advisory Services, a Maryland-based accounting firm. Before founding this firm, Elvis built an extensive career spanning over a decade in various accounting and finance roles. During this time, he collaborated with professionals at all levels of management, helping to develop tailored solutions for complex financial challenges. His ability to understand the intricacies of business operations has made him a trusted advisor to business owners and individuals as he works tirelessly to streamline their processes and enhance their financial strategies. So Elvis holds 2 master's degrees that have shaped his deep understanding of business and finance. He earned a master's degree in science, in business and finance from Langha Nuremberg University in Germany, and an MBA from the University of Baltimore at Towson. His academic background provides a solid foundation for this practical experience. So as a licensed CPA here in Maryland, Elvis has a ton of clients in the healthcare space. That's why I really wanted him to be here, because he understands our profession and understands the members of our field, and has helped so many of them with their taxes over the years. So additionally, he's also an enrolled agent, EA, authorized to represent taxpayers before the IRS. So Elvis' professional qualifications extend beyond accounting. He also possesses life and insurance licenses, further expanding his ability to offer comprehensive financial solutions. So the guy is fluent in 3 languages, English, French, and German. But today the presentation, thankfully, is going to be in English. So Mr. Elvis, without further ado, I'll pass it over to you.
Hello, good evening. Of course, I mean, Leslie couldn't have said it better. But today, what I'm hoping is that I want to make this session very, very interactive, okay? It's not going to be a monologue, like if you, I mean, those of you who have watched Shakespeare in the past, right? Sometimes you have a character going off for like 20 minutes, just talking, talking, talking. So I want this session to be as interactive as possible, okay? I do well when you all ask me questions, okay? So as we go on, please feel free to stop me, ask questions, okay? So the goal today is just to talk about taxes. I know taxes are not the funny, taxes are not fun, but we want to make this as much fun as possible. And the goal is to make sure you keep your hard-earned dollars in your pocket as much as possible. Okay, so everybody with me? So I mean, today we're talking about tax planning for high-earning healthcare professionals, but this is applicable to anybody, right? It could be any field, but we're going to focus a lot today on high-earning healthcare professionals. So I am gonna, let me kick this off. And again, number one question, right? Do you think you pay a lot of taxes? Who is with me? If you think you pay a lot of taxes, chances are you probably do, right? You probably do pay a lot of taxes. And why? Why do you pay a lot of taxes? These are some of the reasons why you think you pay. I mean, some of the reasons that lead to you paying a lot of taxes. Number one, we're going to have filing errors and omissions. So, a lot of people, they think, oh, we're going to get this person who's going to help us file our taxes. And then you omit a lot of deductions, and then you make a lot of mistakes. That is going to be one of the reasons you pay a lot of taxes. Number two, we have a lot of DIY, do it yourself. People will think, oh, you know what? I am going to jump on TurboTax. I'm going to jump on H&R Block, and this software is going to guide me, and then I'm going to save a lot in taxes. But it does not work like that. You need someone to guide you through, because the software, they're good. Software is smart, but it's not going to help you save taxes because you're just talking to a computer. And then we have the hearsay people. Leslie, you're a CRNA. I have a lot of people who come to me, like when I onboard new clients, they'll tell me, oh, this person said this. You can deduct that, you can do this, you can do that. But that is not true, okay? You need someone actively guiding you and helping you through the process. So the hearsay thing does not work. Yeah. Oh, this person said, oh, I can deduct this, I can deduct that. It doesn't work like that. And of course, misunderstanding tax laws. The tax code, IRC, Internal Revenue Code, is extremely, extremely broad. Every day, I, as a professional, I learned something new. If I were to brag and say, hey, I know everything, that is absolutely nonsense. Every day I hear I learn something new, and my goal is to pass this on to my clients. And the good thing about this profession is I do learn from my clients all the time. I learn from my clients. Like, my clients are going to say, oh, okay, this could be done this way, this could be done this way. And I take that and I pass it on to other clients to help them. And of course, you know, people not understanding the tax laws makes them not claim deductions and credits. Because again, like I said, the tax code is extremely broad. There's a lot of stuff going, right? And people, when you try to do it yourself, so we can go back, you know, point 1, point 2, point 3, right? Filing errors, omissions, doing yourself, hearsay, right? It piggys back to this not claiming deductions and credits because people just don't know what is out there for them to claim. And sometimes, you know, people are scared. Oh, they're gonna say, oh, if I do this, am I gonna get audited? Number one, everybody is susceptible to audits. Being audited is not a bad thing, okay? Being audited is not a bad thing, as long as you can justify why you're claiming a certain deduction, you're good to go. So when an auditor comes through and say, okay, tell me why you claim this, tell me why you claim this, as long as you can say, hey, you know what, IRC, blah, 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 says this, I can claim that, you're good to go. So claim your credits and your deductions. And of course, we talk about withholdings. Your tax situation is always going to be evolving, constantly evolving. So when you fill out your I don't know how many W2 people are out here, right? When you get married, you divorce, you know, you have children, your tax situation is constantly evolving. You got to go back and adjust your W4. So what is a W4? Your W4 is what you fill out when you start a new job. And a lot of people, unfortunately, when they fill out that W4, the thing is forever. Each time each time your life situation changes, you got to go back and adjust your W4. If you divorce, you get married, you know, you got to adjust your W4. And last but not the least, what we're going to be focusing a lot today is the lack of tax planning, which is why we are having this conversation. That's what we're going to be talking a lot about today. Okay. So what is tax planning? He who fails to plan, plans to fail. Winston Churchill. I'm sure we all have heard of that man before. So anytime you say, hey, you know what? I'm just going to wing it, it's going to come back and bite you. Tax planning is when a taxpayer makes use of the law to pay the least amount of taxes. I highlighted makes use of the law because do you know the difference between tax planning and tax evasion? So what is tax planning? Tax planning leans on tax avoidance. So tax avoidance is completely legal. We preach tax avoidance. Tax avoidance means we make use of the law to not pay taxes. Tax evasion is the deliberate illegal means to not pay taxes. That means you underreport your income and you exaggerate your expenses. So tax evasion is always gonna get you in trouble. Tax avoidance, we make use of the law. There's a lot of tax codes, a lot of tax. There's a lot of ways, there's a lot of means to avoid, I said avoid paying taxes. Avoidance is legal. Evasion is illegal. And of course, that means This is always going to be a proactive and ongoing approach. So you don't do it once a year, once a month. Okay. So you don't just say, okay, you know what? Oh, I did this, and then I'm good for the rest of the year. It's ongoing, monthly, weekly, ongoing. You adjust stuff, right? Because your income is going to go up, it's going to go down. And you got to find ways to make this process an ongoing approach. And how do you do that? Of course, you review your income, you review your deductions, your investments, and your tax credits. All right, let's talk a little bit about the income tax formula. So tonight, I don't think you're going to become tax experts, but just understanding the income tax formula would help you understand how to avoid taxes. Okay. So what is your income? Your income is derived from all sources. Your wages, interest, your dividends, your business, your rental, alimony, retirement, foreign income. I mean, I'm a foreigner, okay? Some people think, oh, if I'm making money from Cameroon, I don't have to report that. As long as you are a US citizen, you have to report your income. So all sources. And of course, illegal income needs to be reported. You all have heard of Al Capone, the gangster, the famous gangster. How do you think Al Capone was not indicted because of his, killing people or doing stuff? They got him for tax evasion. So illegal income is reportable because the IRS is going to get you for that too. All right, so we start with income. Then to get to the adjusted gross income, these are the deductions, right? You deduct if you're a teacher, you have education, you got educator expenses, your HSA and all that stuff, right? This is what you start with income, then you deduct this, and then you get your adjusted gross income. And then how do we get to taxable income? To get to taxable income, you can either deduct the greater of standard deduction or itemized, right? Do you all know what standard versus itemized deduction is? Do I need to go into that or?
Yes, please.
Okay. All right. So standard deduction is what the government says, right? Say, okay, you know what? Every year, if you're single, you can deduct $14,000. I'm just throwing these numbers out, okay? If you're head of household, you deduct $18,000. If you're married, you deduct this amount, okay? Itemized is where you start. You have your property taxes, you have your interest from your home, you have donations to charity and so on. So if you add that, okay, so you have what the government gives you for free versus, whatever your property taxes, charitable deductions and all that. So whatever is higher, the government says, okay, take this and deduct that.
Okay.
Are we on the same page?
Yes.
Okay. So once you get this, you take either your standard deduction or your itemized deduction, whatever is higher. Okay. Government says, okay, take whatever is higher. You get it to your taxable income. So your taxable income, and then of course, if you're a W-2 person, taxes are coming out, and so on and so forth. Then if you have credits will be like if you have a child, right? You have a child, you can deduct $2,000 for just having a baby. So I mean, I encourage you all to go have babies. Okay, do what you got to do. Yeah, because they come with credits, even though they're extremely stressful. But yeah, the credits, they do accrue. So when you do that, you're gonna get your total tax due. And your total tax due, if you're so whatever you paid in during the year through W-2, W-2 taxes that are taken out of your W-2, if the W-2 taxes withheld are higher than whatever your taxes, okay? So with tax planning, I can look at your income and then I can calculate it and I'll tell you if you're gonna owe or not. So during the year, if you have enough withheld, you are gonna have a refund. If you don't have enough withheld, you're gonna owe taxes. Everybody on the same page?
Yes, and Mr. Langha is going. If you guys have any questions, drop it in the chat. When he's done with the presentation,
Yeah.
no, I'll man the chat. Whenever he's done, we'll open it up so you could ask questions as well. So we'll just keep going. Then at the end, we'll open it up and you could come on camera and ask questions or just speak.
All right. So this is a very, very, very important slide. So this is the 2025 tax bracket. And as you file taxes, you're going to file taxes either as a single person, head of household, married filing jointly, or separately. We generally encourage people to file married filing jointly. Okay, people might have told you, oh, married filing separately. That is the worst situation. That is the worst route you want to go. There are, of course, instances where we'll say, okay, you know what? It makes sense to file separately, but married filing separately, that's why we have it all the way over there. That's the worst instance you want to go. So if you look at the green, right, you're going to see there is 7 tax brackets. And depending on where your income is, if you are the 10% tax bracket, the first 11,000, so this is 2025, the first 11,925 is going to be taxed at 10% if you're single. And then, of course, you got the married filing jointly. I'm going to go over that. Stay with me, please. So take a snapshot of this picture. I'm going to go into that a little bit, and it's going to make sense to you. Okay. So how do tax brackets work? We are going to assume your income is 60,000. If your income is 60,000, I'm going to go back right here. Okay. So we'll assume you're filing single. If your income is 60,000, the first 11,925. 11,925 is going to be taxed at 10%. Okay, so don't think, oh, you know what? All my income is going to be taxed at whatever, like 22%. The way this works, the first 11,925 is going to be taxed at 10%. Okay. Then the next. So we got 12%, 11,926. Okay. That amount. So the next 11,000 through 4875. Sorry, 48,475 is going to be taxed at 12%. So we don't tax the entire 60,000. So the first 11,926 gets taxed at 11,925. And then the next, it's going to get taxed at 12%. And then 48,476. You see that? It's going to get taxed at 22%. Why is this important? The goal is we want to make sure you don't get into the next tax bracket. So you see that? That's 10%, 12%. That's a 10% gap. And then you got a 2% gap. So the goal is that as we are monitoring your income, we want to make sure that you don't jump tax brackets. Because every time you get into a new bracket, that income gets taxed. So see this, right? You go from 48,475, and then all of a sudden you are 22%. That's a 10% gap. Is everybody following me? So you start at 10%, that amount gets taxed. Then the next gets taxed at 12%, and then the difference right here, 22%. So imagine you come in at 104,000. Right there, you just got into a new tax bracket because you didn't plan enough. And of course, marginal tax rate, your marginal tax rate is the next dollar. It's a dollar you pay on the next tax, on the next income you earn. And then the effective tax rate is just your total income divided by your tax. So your total tax divided by your total income. So as you notice, your marginal tax is 22%, whereas your effective tax, which is your total tax divided by your total income, is 13.5. So how do we pay less taxes? We are going to shift income. How do we shift income? We shift income to family members. If I have kids, my kids are going to earn less income. They're going to be in a lower tax bracket. How about I hire them and I pay them? But don't just go hiring them because you want to shift income. It's got to be legal. Again, we advocate legal tax strategies. Okay, so you shift income to family members. Maybe your parents are retired. They're in a lower tax bracket. You hire them, let them help you in some capacity. You shift income to them, and you pay lower taxes. You also shift income through years. Today, you are actively working. You are making a lot of money. So you can shift income through either your 401k, through your SEP. So SEP stands for Simplified Employee Pension. You can also shift income through pensions, right? I mean, I have clients who are shifting income. They're like diverting about 300, almost $400,000 through their pension. And what is the goal? The goal is because once you retire, you are going to be in a lower tax bracket. So active income is going to get you like taxed the most. But as you shift income, either through family members, through years, or through entities. What are entities? Your S Corp, your C Corp. I know a lot of people always lean towards the S Corp strategy, but I would argue that that's not always the best way to go. Because right now, through a C Corp, right, a C Corp is taxed at 21%, right? But if we go back here, so S Corps are flow-through entities, right? So with a flow-through entity, the income you derive from your business is going to end up on your personal taxes. So if you look at this, 37%. So whatever income you derive from your S Corp, your LLC, or whatever, it's going to get taxed at 37%. But C Corps, they have a flat 21%. So S Corps might not always be the way to go. I don't know how the new tax law is going to go. But right now, C Corps might be something very, very, interesting, something to consider. So I wanted to talk, this is where I wanted to open up a few, open, question and answer sessions. Okay.
Fella,
So
you want
yeah.
I want to open it up to the audience at this
Yeah.
section. Go ahead,
Yeah.
Elvis.
Yeah,
Okay.
yeah. So we wanted to talk about a few. I mean, I didn't want to delve into a lot. I didn't want the tax code is very, 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 very broad, right? And I wanted to talk about cost segregation. I wanted to talk about Augusta rule and a bunch of things, right? Thus, I mean, do you all have questions about that? Cost segregation. That is a very, Excite is a real estate company, right? So I wanted to talk about that a little bit. So depreciation. Depreciation is the systematic allocation of cost over a period of time. So if you purchase a property or you invest in real estate, you are not going to write off the deductions immediately. With depreciation, you can take, I mean, we can talk about 179, we can talk about a bunch of things, but with depreciation, you allocate those costs over a period of time. But with real estate, cost segregation entails making sure you get an engineer to help you claim the most deductions over a period of time. Residential properties, you depreciate that over 27 and a half years. Commercial properties, 39 years. That's what the tax code says. So if I bought a building today and I have a refrigerator in there, I have a stove, I have think about it. Those that equipment, right? Like your stove, your stove, your fridge, and all that, they get depreciated over a shorter period of time. And if if you do the math, right? If the denominator is lower, right? 5 years versus 27 and a half years, you get to claim a lot upfront. But what a lot of people don't know is when they purchase their real estate, they are just going to say, oh, you know what? I bought this building for $500,000, $600,000. I'm just going to take that. I'm going to depreciate it. But with cost segregation, you have to actually, like, it literally says it, right? You segregate, you separate the costs. You said, okay, you know what? The stove, I can depreciate it over 5 years, and so on and so forth. And that's what a lot of people don't know, you know. And let's you can chime in on this, you know. But
Yeah.
yeah.
So yeah, cost segregation, definitely powerful tool, and I think the Trump tax credit even made it even better, where you're able to accelerate that depreciation.
Mm-hmm. Yeah. So what we're saying is we can
Because a
also
lot
go
of the
over.
people, yeah, because a lot of the people on this call are like hardworking professionals. So what are some of the expenses that they can deduct to reduce their taxable income?
So we are going to talk about being a real estate professional, right? So there is active income and there's passive income. So you cannot deduct passive income. Sorry, you cannot deduct passive expenses against active income. So if I made $100,000, if I netted $100,000, and then my real estate expenses were $800,000. If you're not a real estate professional, you cannot take the $800,000 to offset your active income.
That's for depreciation, correct?
No, not only depreciation. So there's active income. Active income is what you're doing, right? You're working. Passive income, it could be through your portfolio income. So let's say you invest in stocks. That's portfolio income. If you made a lot of losses, you cannot take the losses from your passive income or your portfolio income and offset your active income.
Got it.
Okay. So I just made $100,000 active income working. And then my portfolio income, you know, your real estate, your stocks, your bonds. If you made a lot of losses from those, you cannot take those losses and offset your active income. This is where the tax planning comes through. We are going to set you up with an entity that is going to generate passive income.
Okay.
So if you look at, let's take a medical doctor. Let's take a medical doctor. So the medical doctor, he's going to be doing, let's just say, surgery and a bunch of things. What we're going to do, we're going to set up an entity, another business, and then we're going to shift that income. Okay, the stuff that he does not actively do, like hands-on stuff he doesn't actively do, we are going to shift that income to that entity. And at that point, his portfolio losses or his passive losses, we're going to use that, and then we're going to offset that income. So remember, passive and active, they don't go together. But if we set up another entity, we say, okay, you know what, Dr. Blah, 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 blah. You know, the stuff that you're not actively doing, we're going to shift that income to that entity. At that point, the passive losses from the portfolio or the other stuff, real estate, can offset that income.
Wow, that's a powerful strategy that like a lot of people on our platform can leverage. Guys, everybody, you on the call, if you have questions, please drop the questions to Elvis. You could come on camera and speak as well. Don't let me hog this time because I'll keep asking questions.
Yeah, let's make this as interactive as possible.
This
is it's a lot. It's a lot. I mean, if I had to go through every strategy, you know, I mean, we're gonna be going on for hours.
Joy, I see you. Your volume is your mic is on. You can go ahead and ask the question if you have a question.
I don't have any right now.
Okay.
Okay.
So can you go into some expenses, like regular expenses that can be deducted from like, let's say somebody working W-2 or 1099, what are some expenses that they could deduct to decrease their taxable income?
So the bottom line, right? The bottom line, what we always say is it's gotta be regular. So regular, you know, in your field of work, okay? If this person deducted these expenses, okay, with the next person, so you think again, you're in the medical field, okay? What is this person, what is this professional gonna deduct versus the other professional? You know, so as long as you have everything going, right? There's ways you can deduct, you can write off your vacation. Okay. And you can also, I mean, your car, you know, but we just say, hey, you got to be smart about that. You've got to be smart about it, because I got a lot of people and they make very, very dumb, dumb decisions, and they end up getting audited. But there is a lot of stuff as long as you plan for it, right? And I don't have my tax planning book here, but there is a lot of stuff that you can legally write off. So expenses, what can you write off? Again, we're just gonna say it depends. If you have some expenses you want to throw out there and say, okay, can I write this off? Okay, we can talk about those. You know, but if I just say, oh, you can write this off, you can write that off, you can write it off. You know,
let's say, for example, I'm a medical professional. Can I write off like my stethoscope, my scrubs, my uniforms, and all the stuff that I spend money on?
Of course,
Okay.
Of course, yeah. So the goal is section 162. It's going to be regular and customary, right? So it means, okay, if this person can write that off in my profession, we can do it.
All right, everybody, any questions in the chat? Any questions? Nena, I see you had your hand up. Do you have a question?
Oh, my student loans more than 2K maximum.
Say, can I write off my student loans more than 2K maximum?
Do you own a business?
Yes,
right.
She owns a business.
So what we are gonna do is, for 2025, you can write off up to $5,250, as long as you have an accountable plan. So up to $5,250.
What does that mean, accountable plan?
So an accountable plan is where the business says we are going to pay, you know, you're an employee. We're gonna take care of your student loan.
I see. So
Right?
I
Like when
have so,
you used to work, right, for a business. I mean, you own your business now, but when you work for an employer, right? Remember they said, okay, we're gonna reimburse you this amount annually.
I see. So for
But it's
example,
gotta
right
be
now,
right. Yeah, it's
so
gotta
for
be
example,
right.
right now, I own a business. My wife works in the business, so I could write off $5,200 and say that's part of my wife's tax towards a student
Yes.
loan.
Yes. Yeah. It's
That
gotta be in writing. You gotta make sure
yeah.
the plan is set up.
Wow, that is powerful. Marshall had his hand up. Go ahead, Marshall. Marshall, then I'll go to Tita. Marshall, you're muted if you're speaking.
I unmute myself. All right, I was talking about when I receive my K1s and I have all these numbers. I don't know if Les, if you can throw like an example out there for him to tell us exactly somebody who is doing this passively, what can I actually include to decrease my burden on my W2 income?
Okay, that's a great question, right? So we have a lot of investors that invest in our assets, and they get depreciation loss, passive depreciation loss. For example, the asset that we're closing on, if somebody invested $100,000 for their 2025 taxes, like the taxes that they're going to file next year, they'll have a passive loss of about $27,000. Now, how can they leverage that $27,000 in passive losses to offset their income? I know you talked about reallocating some of the active income into like a passive entity, and that all of that income now can be the passive loss can be counted against that income. Is that's what you said, right?
Yeah. So the good news is that you get to carry that forward. Okay. You carry that forward forever. So it doesn't expire. It doesn't expire. But if you want to make use of it, you would have to probably set up another entity, and then you're gonna bifurcate. Bifurcate is just a fancy way of saying separating. Okay. Look at what is passive, what you're not actively doing. Okay, like we talked about it. Like, again, you all being in the medical field, you set up another entity and then you see what is passive. What are the stuff that are not actively involved? What am I doing actively? That is going to be passive. And then you can use the passive losses to offset the passive income. But
that is really powerful.
Yeah, me not being, I'm not in healthcare, but you got to look at it, say, okay, what do I actively do versus what do I passively do? Okay. And then all the passive stuff, we are going to move it to that entity, and we're going to use that passive income. Sorry, we're going to use the passive loss to offset the passive income.
That's a powerful strategy right here. Tita, go ahead. We have some questions in the chat. I'll come to that next. Go ahead, Tita. You can unmute yourself.
Good evening, Leslie. Good evening, brother. Thanks for very elucidating presentation. So my only question is, for somebody who is doing both W-2 and 1099 or locum staff, specifically for healthcare providers, for us CRNAs, are you able to still leverage some of these SEP things like a SEP IRA or SEP 401k, even though you have a 401k at the W-2 side? And as a follow through to that question, would you be able to claim deductions that, say, for instance, I attended a conference and the conference was paid for by my W-2? Can those expenses be also claimed from the 1099 side? Thank you.
So you said you have a 1099 locum tenens, right? And
Yes.
okay,
And the W2, you do both. You do like 50-50. You're like a full-time W2 and at the same time a part-time 1099 under your business entity, you know.
yes.
How does that work in that situation with regards to expenses and they take advantage of solo things like the 401k and the SEP IRAs and stuff like that?
Yeah, you I mean, every entity you have, right, can have its own 401k or a SEP IRA. Okay. So if you have like 5 businesses, each of those businesses can have its own 401k. Okay. And then of course, I mean, we want you to keep track of expenses, right? I mean, we don't want you to move like shovel stuff around. Okay. So if you have this business, if you're working, you're driving, you're doing stuff for your 1099 stuff, we want you to keep track of that. We don't want you to, commingle.
So how many retirement accounts can you have? Let's say you have like 3 different 1099 positions. So you're saying like each business can have its own retirement account. Isn't there a maximum that you could contribute as an individual?
There is a maximum, but every single business can have its own.
Every single business can have its own maximum.
Can have its own retirement account. Yes.
But all the businesses combined cannot go past a certain number.
No. Each, I mean, so if you have I'm gonna say Leslie LLC. Okay, Leslie LLC can have its own 401k or SEP IRA. Then Awasom LLC can have its own, 23,000. Yeah.
Wow.
Okay.
Yeah.
Okay, sorry, Leslie. If Leslie at that point in time is still a W2 employee, you're saying the same Leslie can have a 401k at work or
on its own
at work, and
that
at the same
correct.
time, Leslie LLC can have
that is correct.
Step 401k, and Awasom
Yes.
LLC can have its own step. Each of them maxing out for the
Yes.
max for that year.
Exactly.
That is a powerful strategy, brother.
Exactly.
So next question is like, I think this is from Edit. If you can't use passive income loss to offset active income, then why do tax planners recommend opening an LLC for tax planning? Is that in reference to, do you think it's because they're advising you to open that LLC to reallocate some of the income to make it passive? Or Edit, you can come on microphone and clarify. I don't want to ask the question for you.
Edit. Let's get this situated. Okay. LLCs are for liability. When you set up an LLC, you're setting it up with the state, with the Secretary of State of whatever state you reside in, because you don't want to be sued personally. Okay. So the LLC shields you from people coming after you personally. Anybody who ever said LLCs are going to save you taxes, it's a lie. LLCs are just for liability protection. LLCs are never, ever going to save you taxes. LLCs shield you from liability. No one is ever going to come after you personally. That's why you set up an LLC. So if anybody ever said, you know what, set up an LLC, you're going to save taxes, that is a lie. LLCs are just for liability protection. Are we on the same page?
Got it.
So if anybody ever said set up an LLC, you're going to save taxes, it's a lie. LLCs do not save taxes. They protect you from liability so that no one can ever come after you personally, right? If you owe somebody, the LLC is going to shield you from people coming after your house, your cars, or whatever. That's what LLCs are for, limited liability company. So if anybody ever says a I hear this all the time. People say, oh, limited liability corporation. No, the C stands for company. Limited liability company. And then the corporation is the Inc. Whenever you say Inc., INC, that's a corporation, LLC company. So if anybody ever told you, oh, it's a limited liability corporation, that is a lie.
Well, but sorry to interject. We are meant to understand that you can elect to be taxed as an S corp even if you're an LLC. How about that?
Yes, yes. So as an LLC, you can either elect to be taxed as a corporation or an S corporation, right? Like I was talking, I said earlier that right now, people always tend to default to an S corporation. It's good, but that might not be the best strategy because C corporations are taxed at 21%, whereas I know all my CRNAs, they are in the 37% bracket. So S corps, they flow through, to your personal taxes. Think about it. 21% versus 37%. I don't know how the new tax law is gonna go, right? But think about it that way. Right now, C corps get taxed at 21%. That's a max. That's a cap. So Amazon, Google, they all get taxed at 21%, whereas you all get taxed at 37%. Is that sustainable? Oh,
So what's the
you're
benefit of
encouraged.
so what's the benefit of getting the S corp then?
That's a great question. No, S corps is just that you don't pay self-employment taxes, and if we had to go through that, it's gonna be, like a very, very thorough session. So think about it this way, right? You look at your W-2 or you look at your paycheck. Your paycheck, you are gonna have Social Security and Medicare coming out, right? Are we all familiar with that? Social Security, Medicare?
Yes.
Okay. So with the S corp, you avoid paying Social Security and Medicare on your net income. So if you don't do an S corp election, let's say you make $100,000 net. I'm just going to keep it simple. We net $100,000. Okay. So of the $100,000, that number is going to get hit with self-employment tax. And what is self-employment tax? Self-employment tax is Social Security and Medicare. If you do an S corp election, you do not pay that. And this is something probably I have to do like an illustration so that you can see it. You can see how it works. But that is the benefit of having having an S corp, because self-employment tax, if you're an LLC, like we said, you do not save taxes on being an LLC. So with an LLC, you are just, it's just liability protection. But if you're an LLC, 100,000, you're gonna get hit with 15.2%. But if you're an S corp, it's gonna be 7.665%. And again, I don't want to. It's a lot of numbers.
This is great stuff, Elvis. Got some more questions here. I think Timmy said, yes, I heard people were taking off more than that, almost like 5 figures. I think she's referring to like the student loan deduction, that people were taking more than 5 figures for like the student loan deductions. But you said the maximum is 250, correct?
Yeah, that gets adjusted for inflation annually. So in 2025, it's 5,250.
Okay.
So the employer, if the employer reimburses the employee,
So is there a limit to the number of employers that could give you that benefit? Let's say if I have two businesses and I'm employed at both, can I get that benefit for both of my businesses and contribute like that towards my student loan?
Yeah, I would say yes. Because it's two different employers, right?
Yes.
Yeah.
Okay. So there you go, Timmy. Another good way. I told you by the end of this call, you'll be able to save at least $1,000. Now you've saved $10,000. So Natalie asked the question, will you encourage the use of a mega backdoor Roth with your W-2 while participating in a 401k plan? Additionally, how do you determine what amounts to put towards each?
It's an excellent question. Well, I mean, we Roth, right? So we have a traditional IRA versus a Roth IRA. You know what the difference is? So with a traditional, whatever you defer, right? You don't pay taxes on it today. With a Roth, you pay taxes today, but when you withdraw, you don't pay taxes. So keep it simple. If I defer $5,000 into my traditional IRA, I'm not going to pay taxes on anything today. Whereas with a Roth, if I defer money into my Roth, right? It's good. It's good. You're going to pay those taxes. The taxes come out upfront, but whatever the amounts grow, right? When you defer it and it grows, right? You're not going to pay taxes on that. But again, to each his own, Natalie. So if you say today, you know what, I am just going to do a mega Roth, okay? It's good. When you draw money in the future, you don't pay taxes. Whereas with a traditional, once you draw, you pay taxes on that.
Got it.
Did
So
I
short
answer
answer
your
to the
question,
question is,
or you want to
so the answer,
follow up?
Natalie, did that answer your question?
No,
No?
no. I mean, I know the difference.
Okay.
Yeah, I understand the difference, but then my question is, will you encourage people to do it? I know your answer was to each its own, and then the second part was, how do you determine? I know there's a max, but how do you determine like how much to put in? Because my W-2 right now, I do have matching, but then actually I don't know, but I don't think that putting 6%, right, on my 401k, I don't think I should do that even though they match. So I'm thinking maybe I do 3%, and then like use the other 3% that was going to be taken off pre-tax. I can just backdoor that one. So that's why I don't know, if I should do that or
So what I'm going to
just
say, it all depends on your goals. Okay, it depends on your goals, and every year, of course, the 401k amount gets adjusted, right, for inflation. And for 2025, it's, look it up,
I think it's is it 23,000?
23,
23.5.
oh, 23.5.
yeah.
Yeah.
Sorry to interrupt, because you talked about like a form of passive income, right? So that's why I figured out if I do a mega backdoor, like I would, again, you don't always account for all gains, but I would gain some money in the market, which when I take it out when I'm older, 5 years from now, I won't pay taxes on it.
With the Roth, since you're paying, since it's already taxed upfront, right?
Right.
The gains are not taxable.
Are not taxed. So that's, to me, that's a form of getting passive income too, like making the money work for you. But I just don't know, what percent of my check to put towards that.
There's a backdoor Roth.
Yes.
I guess that would depend on it would depend on how much money you're trying to make, right? Or how much you're trying to invest in the stock in the market. Because I believe the limit to that is like $46,000 a year that you could do on the mega backdoor Roth. So again, it depends on how aggressive you want to be on your tax strategy to do that.
Yeah.
Okay.
Does that make
Yes.
sense? Yeah,
Yes.
but
Yes.
definitely
Yeah.
the income from that is passive. So if you were able to pull out some of that income, any passive losses that you have should be able to go towards that for sure.
And I mean, since you're doing a mega Roth, right? Because keep in mind the Roth is taxed upfront, right? So when you pull that income out, it's not going to be taxable. But there's rules to that, right? I mean, you have to have had it for at least 5 years before you pull it out, and then 59, it's a couple of rules. Because of course, the tax code is never ever straightforward. But
Yeah, dude,
yeah,
you're
yeah,
taxing me like heaven already. So at this point, it's
yeah. No, you need to have held it at least for 5 years, okay?
yeah.
Don't
No,
put it as of today,
I
and then
read that
tomorrow you
on the
withdraw it.
yeah, I read that on the Vanguard site. I just wasn't. I just needed more insight. Thank you.
Yeah.
And one other strategy that probably Elvis did get the time to go over is like tapping into leveraging like self-directed retirement accounts, where you could like especially 1099 employees, you could run like a solo 401k, where you could, like he said, income reallocation. You could reallocate a lot of your income towards that. And then that solo 401k, which is controlled by you, you could use it to invest in whatever you want to invest in, whether it's like the stock market or real estate or other options like that. So that's other one very powerful tool for healthcare professionals, especially the 1099 folks, because you can really maximize your contribution to a solo 401k. And like Elvis said, if you have different entities now, you could have each entity setting up an account for you, and then you maximize it. You're able to reallocate income towards that, and then that decreases your tax basis. But now that income in that retirement account, you could use it to invest in whatever you want to invest. So like that income reallocation strategy is really powerful. So it's something that so that is a lot of value. Can you speak to investing into a defined benefit plan as a 1099?
Of course, Emmy. So there is two types of contributions, right? There's two types of retirement contribution plans. Sorry, there's two types of retirement plans, right? You have a defined benefit plan and a defined contribution plan. So a defined benefit plan is your traditional pension, which I doubt a lot of companies do these days, right? So with a pension, you work, and then your employer is putting money into your pension plan. So that's a defined benefit plan. Whereas a defined contribution plan is your traditional 401ks, your SEP IRAs, what else do we have there? But if you are doing a defined benefit plan, I have a client, they put in about so this year they put in $320,000 into their defined benefit plan. So the defined benefit plan is that you set up your pension, you're 1099, you make a lot of money like you all do, and then you set up your pension, your defined benefit plan, and they just put in 320. My numbers might be off, but it was over 300,000. So that's $300,000 you are not paying taxes today. Of course, when you retire, I'll find that out for you. I'll find that out for you. Yeah, but with a pension, you can defer a lot of money into retirement. Of course, that's contingent on your salary and a bunch of other things. We work with an actuary, and if you have a financial planner who can help you with that, that's good. If not, just contact me and I will help. I'll refer. But yeah, that's
Elvis, you want to drop your contact in the chat so that anybody that is looking to get in touch with you to carry on the conversation, they could easily reach out to you. But I hope you guys are getting a lot of value from this. Our goal with these webinars that we host here on Thursdays is to provide a ton of value to our community. So we reach out to partner with experts like Elvis to come teach us about topics that we're not experts at. At Excite Capital, we are experts in real estate, specifically multifamily real estate. So everything else, we got to bring somebody else to come and teach you guys and teach us so we learn as well. So I'm glad you're getting a ton of value. We've been getting some really good questions in the chat. So, and the recording for this will be sent to everybody that is registered. So you get a recording for this at the end. If you have any other questions, guys, drop it in the chat. You have questions, you could come on camera and ask, or you could turn off your mic and ask if you're shy.
Yeah, they're all shy. Come on, let's put some faces.
I think is the way we set it up. We set it up as a webinar, so that's why. But ask your questions, guys. Please feel free to ask as many questions as you need.
Is there a certain income that you have to have to contribute that amount into that defined benefit plan? Like, so do you have to be like, oh, you make this amount, so this is the corresponding amount that you can contribute?
Yes, absolutely. Absolutely. So that's contingent on your income. So you can't make $10,000 and contribute 300. Yeah.
Okay.
Yes.
Okay.
Yes. Yeah. So it's contingent on the salary, but you know, there's a ton of benefits. So tax code, just so you know, right? There's about.
Elvis, don't forget to drop your contact in the chat.
Oh yeah, I did. Yeah. So there's about. You don't see it?
No.
Oh, it's there.
I don't see it.
Am I messaging? Oh, it looks like I'm messaging Tenny. Tenny, can you please put that? Oh, that was a direct message to Tenny. Oh, I see. Okay.
Yeah, I can put it to everybody.
All right, Tenny will drop the contact in the chat, guys. Feel free to reach out to Elvis if you have questions. I see some more people turn their camera on, their microphones on. Go ahead and ask your questions. Everybody's shy to ask questions. Nobody wants to save money.
I mean, I'm at the office, right? I left my 3-month-old baby.
Congrats on the baby, by the way. And guys, ask as many questions. If we don't have any more questions, we will wrap it up. I see Elvis's contact is right there in the chat. His email address, phone number, and his website, which is lgeadvisory.com. Again, that's lgeadvisory.com. And to everyone, if you would like to get more events like this, more education like this, we continue to provide this kind of education to members of our community. Our team is going to send you a link in your recording. You're going to get a link of our Beyond 9 to 5 community as well, where we host events like this. We're probably going to have Elvis come back at some point in the future. So put your questions together. And again, if you don't have any more questions, we'll wrap it up. Elvis, any final words as we wrap it up?
Yeah. What I wanted to say is that, I mean, we just scratch the surface of, strategies, right? Everybody has a unique financial situation. So that's why we just scratch the surface, right? If you want us to like tailor stuff directly at you, please contact us and we'll get this going. And, I look forward to having more of these sessions.
All right. Thank you so much. I know it took a lot for you to be here. Please extend our gratitude to your wife for letting you come and do this presentation with the young baby at home. Everybody, thank you so much for attending, and thank you so much for the questions. We all learned from your questions as well. We truly appreciate you being part of this presentation. On behalf of our CEO, Dr. Julius Oni, my other co-founder and partner, Tenny Tolofari, and our entire team here at Excite Capital, we just wanted to say thank you. Thank you for taking the time to join us this evening. We appreciate your attendance and your attention, and we look forward to our next webinar. Again, Look out, we're going to be announcing these things. There's a ton of value coming your way in 2025. So 2025 is the year where we all think beyond our 9 to 5 and create variable income sources beyond our 9 to 5. So we look forward to you all joining us on this journey. Thank you very much and have a good night, everybody. Thank you.
You all have a good night. Thanks, Leslie.
Take care, everybody.
Same routine, playing like a broken refrain. Monday to Friday, clock just ticks away. Years are passing while my dreams fade away. 9 to 5, eating up my life. 9 to 5, cutting like a knife. But I refuse to let it be my story. I'm turning pain into glory. Started learning, staying after hours, becoming wise, gaining hidden powers. Every meeting became my classroom, yeah. Every challenge showed me who I am. Yeah. Yeah. Took the system that held me down, flipped it over, now I wear the crown. Experience became my greatest tool. Now I'm teaching others all these rules. 9 to 5, transform my life. 9 to 5, cutting like a knife. But I refuse to let it be my story. I'm turning pain into glory. 9 to 5, eating up my life. 9 to 5, cutting like a knife. But I refuse to let it be my story. I'm turning pain into glory. Started learning, staying after hours, becoming wise, gaining hidden powers. But I refuse to let it be my story. I'm turning pain into glory. Started learning to glory. Started learning to glory. Started learning to glory. Started learning, stay learning, repaying my time. Me down, leaving it behind. But I'm 9 to 5. Beyond the grind. Beyond, leaving it behind. But I'm 9 to 5.